Welcome to Manifold. My guest today is John Seo. He is the founder and CEO of Fermat Capital. His hedge fund invests in cat bonds. We'll explain what that is later in the podcast. John, welcome to the show.
All right. It's great to be here, Steve.
So John, I don't know if you remember, but about almost 15 years ago, I invited you to give a colloquium in the physics department at the University of Oregon, and you were kind enough to come out to Eugene and give a very interesting talk, not just about cat bonds, but about a kind of theory of risk. And I think something like discounting in the space of probability functions, something of that nature.
Yes.
Which was a little bit theoretical, but I think the physicists really enjoyed hearing about it. So I still remember our conversations from back then. And since I started the podcast, I've been meaning to touch base with you because I thought you would be a really interesting interview for my audience.
Yes, absolutely. I mean, well, you remember it well. So it's something that I learned as when I was quite young. My father and I can't figure out exactly when it was that, but I was probably about like 10 years old. We know because he was working on a paper. We know its publication date. And he was explaining to me that, and he was a mathematician by background, algebraic number theory, but retooled as an economist, right? And so naturally, what they did in those days, they tended to stick people like that into this field called decisions under uncertainty. Yeah, this is very mathematical. And he said that there was a particular problem, what he called the investor choice problem, that is actually technically unsolved. And as you know, too, it's like math. My mother's a mathematician too. All they do is they talk about unsolved problems, right? Like, oh, if you can solve this problem, that's a 300-year-old problem, 100-year-old problem, et cetera. So here's an unsolved problem. I thought it was interesting. He was explaining it to me just to talk it out loud, really. And so I was like, okay, so like, what's your strategy? Like, what, you're going to like chip away at that? And he said, oh, I'm going to do it even better. I'm going to prove that it's unprovable. I'm going to prove that there is no solution. I mean, that's a type of proof too, right? It doesn't exist. And I don't know why, I got upset and I just said, no, Dad, you can solve this one. It can be solved. He was like, what? No. And I remember he told me, again, growing up, he said, oh, there are all these problems that people thought are unsolvable. But in the end, this guy, you know what he did? It's classic divide and conquer. He divided and conquered, and he tried to explain it to me. I was like, yes. These things can be. I go, Dad, divide and conquer. You can divide and conquer this. And so I was really intrigued. And it turned. So it was just after dinner, and it ended up that we argued all night until the sun came up the next morning. My mother got up to make breakfast for everybody. She couldn't believe that we were still in the living room, like heatedly arguing about this. So she broke it all up, and that was it. And we never talked about it again. So, but I always remembered that. And so, really, when I came to you and talked to your students, I was talking about actually the solution to that problem. It's actually a trade secret. It's very proprietary. They should have killed everybody in the room, but I thought they would. I thought, they'd enjoy seeing it, but really that was actually, something that from a very early age was planted in my mind. It's like, how can you solve this problem? Well, the field at that time really thought it was unsolvable. And it turns out that, like a lot of these things, when you see it and understand it, you realize that the parallels to other solutions that were used in finance going back almost 1,000 years are there naturally. And so that's what it was. And of course, that gave me courage to enter the field of finance that I'm in, called catastrophe bonds, right?
Yeah. So what I'd like to do is let's loop back and talk more about this specific question, the investor's choice problem, and how you price expected loss risk, tail risk. We'll come back to that. But before we do that, what I'd like to do is talk a little bit more about your childhood and your education and the story of how you maybe started out as someone who was going to become perhaps a biophysicist, but ended up actually in finance. So maybe we could talk about that a little bit. So when you were in high school, what did you think you were going to do for a living later in life?
Actually, biophysics. I thought I'd be a biophysics professor.
Yes.
So it was like 7th or 8th grade. I was giving it great thought, what I wanted to do, like, do I want to be a doctor or an astronaut or something like that? And then I don't know why, I just had this great, realization that what I wanted to do is study physics, learn all I could about that, and then study biology. I didn't know that the field of biophysics existed. And I thought that would be the interesting thing to do, research for the 21st century. That if you could just take that hard science of physics and then understand deeply biology, you could solve some interesting problems and so forth. And so, yeah, I told my mother that. It was like a 3-hour rant, just like, oh, good, that's great. And I didn't change my mind. I mean, I went to school and then I studied physics. And as you know, when you get into that mode, you would think it's like, oh, of course, I'm going to study this for the rest of my life. It's beautiful and it is and so forth. But when any classmate would ask me, what are you going to do for grad school and so forth? I said, oh, biophysics. I know that. But it's like, but you don't seem to be studying I took organic chemistry, but I go, no, you study physics first, then you study the biology. That's biophysics. So I knew since maybe 7th or 8th grade.
So if I recall correctly, you did your undergrad at MIT, and would this be the 80s or late 80s?
Yeah, 84 through 88.
Okay.
Sorry.
At MIT, and then for graduate school, you went across Cambridge to Harvard.
Yes, that's right. They have a biophysics program there.
Yeah. And I think you and I probably overlapped. I came to Harvard as a postdoc in 91, so we might have overlapped briefly.
Yeah. I was there 88 to 91. Yeah.
Yeah. I actually never played this game, but I bet if we tried, I could find a lot of people that I'm probably 1 degree of separation from you in many respects. From
sure. Yeah.
IT and Harvard people. But so as you're coming to the end, though, of your PhD, you're married and you've had a child. Is that right? And
correct. Yeah.
That child was premature, and you ran up some huge medical bills because of the premature pregnancy. Premature birth.
Well, they had to strap my wife in a bed for a little over a month so that he wasn't overly premature.
Wow.
But he was tiny. He was like size of a ketchup bottle. Yeah.
Wow. And
he was fine.
I hope everything's okay with him.
He's terrific. Yeah.
Great. So I guess the health insurer told you wouldn't be covered anymore because of this. So if you were to have another child, you'd have trouble getting it covered.
Yeah, I don't really know. I mean, so I had my second on the way, and then I went from my grad school to postdoc. So I got my doctorate, and I was so confused because the card said a particular insurance company. I guess I'm not going to name it now. It's a fine company. It's one I use right now, actually. And for my postdoc, it was the same company in a way, but someone called me up and said, "Oh, hey, listen, I understand that your wife is pregnant again. Congratulations. We're not going to cover that. It's a pre-existing condition." I said, "But I have the same insurance." They said, "Oh, that's a different insurance. That's whatever." And I think, unfortunately, they really told a fib. It wasn't true. But they convinced me that it wasn't covered, and that, and then the woman actually whispered, "Listen, just find a corporate job somewhere, anywhere, and then they'll cover the kid." That was it. So that's probably, if not for that, I'd be a professor now.
Yeah, I was going to ask you that. So it wasn't any disappointment or disgruntlement in what you were doing as a biophysicist. It was really literally the search for better insurance coverage.
Yeah, that's right. I loved what I was doing back then. I still love the field. I think, it's just terrific too to see that after all these decades, because, back then, frankly, biophysics wasn't capable of much. In my opinion, it wasn't, right? So, but those who were in the field were thinking, were practically futurists, and you say, look, a few decades from now, we're going to be able to start to do this and that, you know? And I love stuff like that.
John, I can't resist throwing this out there because
Yeah.
when you and I met in Eugene 15 years ago, my research was 100% focused on elementary particle physics, quantum field, cosmology, and I didn't do anything in biophysics. But since then, so about 5 years after you came to visit,
Yeah.
I started getting interested in a field called computational genomics. And my rationale was that sequencing costs were going down so fast that I could reliably predict that we would soon have huge data sets, millions of genomes to study. And so I've since devoted a chunk of my research time to this problem of predicting phenotype directly from genotype. So we've now done research in which the training data set is 1 million people. And we know, for example, the height or the eye color or the diabetes status of each of those people. And we also have their genome. And through machine learning and AI, we can build actually pretty good predictors. So we can predict the height of a person plus or minus a few centimeters from their DNA alone.
Wow.
So that's like this, what would have been science fiction in the 90s, because in the 90s, we didn't even have the first human genome, right? So eventually things kind of paid off. And this field, computational genomics, is 100%. It's basically 100% quantitative, AI/ML type stuff. But the data sets are huge. And we only have those data sets because of huge advances in the technology for gene sequencing.
Right. Oh, that's fantastic. Good for you.
Yeah. So we should talk about that offline sometime, because I'm sure my listeners have heard this all before. But you ended up, did you go to Lehman Brothers first?
No, actually, where did I go? I mean, at first it was then a small trading firm that was working out of the Chicago Board of Trade, literally the building itself, which is 141 West Jackson, if I remember that, in Chicago. It had a lot of, not only, but it had a lot of MIT people in it. And so, and there were some people.
It wasn't O'Connor.
Yeah, that's correct. O'Connor.
Well, you went to O'Connor. That's so funny. Okay, great. Yeah.
Oh, okay. So for some people that are kind of, that know the options and derivatives market, they know O'Connor. It actually had a nickname they call it O'Connor University. So I mean, still today, if you look at the large banks or hedge funds, the heads of the options trading desks are O'Connor trained. Again, not exclusively, but it's not unusual. So I'd actually heard stories about O'Connor when I was in high school, or not, because a person that was in the fraternity was working at Texas Instruments at the time. I grew up in Dallas, Texas. And so that fraternity tried to speak to every incoming freshman male just to kind of check them out. So we had lunch, and he told me stories about this trading firm. And of course, I thought it was really fascinating. It was very, very interesting.
O'Connor, I'm class of 86 from Caltech, and O'Connor already at that time was interviewing on campus. So I remember going
that right? That's interesting.
I attended one of their recruiting visits, and I think some of my friends actually went there to work. So
right.
Yeah. So it's familiar to me, even though I think maybe the firm, I don't know if the firm still exists, but it's definitely familiar.
Interesting. It still does, so it was in a sense bought by Swiss Bank Corporation, SBC, although all 19 partners were turned into managing directors. In a soft way, it was kind of a reverse takeover. So they wanted the O'Connor people to scale up the bank's operations and derivatives. And it worked in the sense that Swiss Bank at the time was maybe, I don't know, let's say third place among the Swiss banks, let's just say. And the biggest was UBS. And their goal was to become the biggest. And they essentially did. I mean, they grew so fast and so boldly with these 19 O'Connor partners that they ended up merging with UBS, but it really was a reverse takeover. All the senior management of Swiss Bank were the ones that actually held all the senior roles. So, but UBS was the older, more prestigious bank. And so I think initially Swiss Bank was saying the new entity is going to be called Swiss Bank. They said, come on, look for national pride and so forth. So I do remember this, that UBS, it had a little period in between the letters, because Union Bank of Switzerland, right? The logo actually had the periods in it. And what they did is that after the merger, they stripped the periods out and they changed the corporate name from Union Bank of Switzerland to UBS and stated specifically the U, B, and S don't stand for anything anymore.
Interesting.
That was their compromise, But they had O'Connor in there, so it was UBS O'Connor. And UBS, in a sense, went on to absorb hundreds of boutiques, right? And for a good couple of decades, those boutiques, it would say UBS and the name of the boutique, But I don't know, it was maybe 10 years ago or something like that. They said, look, it's just one firm now, so everybody just has UBS on the card, except for O'Connor. I'm told that globally it's the exception because they think the name is so good that they actually preserve it. So UBS O'Connor still lives on.
I see.
Yeah.
So tell me a little bit about, I've had many friends go through this transition from academic physicist or scientist to financier. In your case, it happened at O'Connor and you had to move to Chicago, I guess. And just tell me a little bit about those years, maybe the next 5 years after you left physics. How did your psychology change? I think you probably had a big advantage over most physicists because you had talked to your dad when you were a kid already about, I guess, utility functions and investor choice problems. So just tell me how your psychology and your focus were changing during those years.
Well, I mean, it was kind of crazy. So I didn't know anything about finance. And, even worse, I didn't so-called care about money. My parents as academics had programmed that into me and I happily accepted it. I think, I think it's not a bad way to go through life to not make money your number one objective. But, these were all really poor preparations for getting into it. I was just, I'd always worked a bunch of odd jobs when I was growing up. And so I was a good employee in that sense. So it's just hey, just give me something awful that nobody else wants to do or something really, like that. And so they gave me a project and they'd say, so look, to find out what the project is, go and speak to so-and-so forth on the 7th floor. So I show up and the person's like, so you're the poor bastard that they gave the project to. Then he explained, it's this is the biggest dysfunctional mess I've ever seen in a project. And it's listen, you're going to have to work with people across 4 different floors. And you should know this project's 1.5 years over deadline. It's just mired hopelessly. So, they gave me kind of what I asked for. So I went on all the floors and people just vent nonstop. So when I was very young, by the way, I didn't really talk. So I was a good listener automatically. I just didn't talk. It was just super quiet. And so it was just listen mode and they just rant forever. I'd just say, who sent you? And it's John on the 7th floor. It's well, you go tell John that, and it's look, I'm sorry, you're just caught in the middle, but, those guys want this, and that's going to shift responsibility to me. And you know what? F that, because they're the only ones. I don't, it was all like this. So I just listened, up and down all those floors. By the way, I needed to build a tool, it's thousands of lines of code. But I couldn't begin because, I'm talking to the end users or the people that need to cooperate. And I didn't understand anything they were saying. I had a lab book, so I write down all the phrases. Then I roamed the floor and asked people to explain these phrases. And after a while, I kind of got the idea. I did that for 6 weeks before writing a single line of code. And then I coded it all up, and it worked, And what was interesting to me is that I finally realized that, if you come outside and you're, say, a math, physics, or electrical engineering, whatever your discipline is, you always think about like these unsolved problems or technical problems, right? And I realized that there's no technical unsolved problem here. It was actually that there was so much money in the business, and it's all relatively new and dynamic, which I like. I thought that's interesting, because like I was used to thinking about science in terms of like, and then by the 2010s we'll probably have this, so it's you're building that, you're preparing for that. This stuff moves really fast, right? Evolves very quickly. It's like hyper, evolution. And so I thought it was all very, very interesting, but I was just intrigued that there wasn't a technical problem. It was like a cultural problem. And that there was so much money that rather than actually causing cooperation, it actually allowed fragmentation, And then everything was so proprietary. I mentioned the 4 different floors. The reason why is that at one time the security guard just grabbed me when I was going in on the 15th floor. And he pulled me back forcefully. And he said, "I've been watching you." Like, yeah. He goes, "You went in on the 7th floor, the 8th floor, whatever floor, and I forgot the other floor, and the 15th floor." He goes, "I happen to know no one has access to all those floors unless they're a partner." So he was like looking at my badge to figure out like how I had access there. So they ran it like the Department of Defense. It's sort of like everybody was, even though it was inefficient, was actually separated and not even allowed to go to another floor so that nobody could piece it all together. But for this special project, it needed to all be pieced together, And then he put me in. They had kind of like a holding cell. And then he came back and he threw the badge in my face. And he was like, "What did you tell me? Yeah, you're a cafeteria worker." So they had it was a big deal back then. They delivered lunch to your desk. So nobody on the business side had access, but the cafeteria worker and partners had access to all floors. So they gave me that status. Oh, also I wasn't being paid. So because I told them I'll work for nothing except for the health insurance.
Oh wow!
So they're like, "Okay, that's what I'll do." I did throw in though, because they made all these huge speeches about money and how does money drive you? Is money important? Does money like motivate you? And so on. So I said, no. And I'm like, these guys are pretty obsessed with money. So I did throw in at the end. I said, "Okay, that's fine. But at the end, I asked that you pay me whatever you think it was worth. That's completely up to you. You decide that." And so, but I was paid zero salary. And so I worked away at this thing here, made it worked. And as I said, it was interesting because it really wasn't a technical problem. It was actually, in a sense, a people division type problem. Everybody was divided, not fully cooperative. There was so much money at stake. To be fair to these people, I understood what they were talking about. The way things were being done is that one group was shifting responsibility and downside to another, while maintaining kind of the upside or benefits of that risk.
Yep.
And they were hypersensitive to that, even if the shift wasn't very obvious, if it was the slightest. And keep in mind, these people, Connor and the OTC options market and FX, for example, they could be 20 to 30% of the global trading volume because they were so precise about how to price the risk, right? They were the most efficient. It's almost in a funny way, if you abstract it, it's almost like high frequency trading before there's high frequency trading. Yes. In the good sense, right? They knew how to spread everything off of everything. So they had a laser accurate bead on where the market was, where value was at any given time. Those two things can be different, right? And then they used that in order to create liquidity, so it was really fabulous, very interesting what they did. I always say this now, these days, the modern market is very obsessed with finding liquidity that's mispriced and then consuming it. Right? Like it's a consumer item. People in those days, not just O'Connor, they actually created liquidity. They made markets appear where there were none before. So in a sense, the culture is hypersensitive to the pricing of these options in a way of risk. So if one group was kind of just pushing over something a little bit and the other group was not properly compensated for it, their culture was hypersensitive to that. If you're from the outside, like, we're all one team. Like, that's trivial, but they were all like hypersensitized. So I thought that was kind of interesting too. So, yeah, I mean, that was my entree. I discovered that it wasn't boring. It was very dynamic, And of course, I had my kid, and then third kid, fourth kid, fifth kid. Yeah. The last straw for me, though, is I actually maintained my postdoc, which I enjoyed immensely, right? But you know how research is, right? So there's no 9 to 5 Monday to Friday. It was just 24/7, right? And I would happily, feverishly be thinking about my problem and so on and so forth until midnight, and then go to sleep still thinking about it, and then you're still working on it in your sleep, and you get up. So it's this really wonderful dedication. I was doing that at the same time that I was working the finance job, and it was just as obsessive. I mean, they had intense deadlines. There are all these big programming challenges in order to write all those things I was talking about. I realized that you could actually rebalance everything politically across all these groups just through simple software. And so I was like, I don't know, I was really probably working like 110 hours a week. And the last straw was that it was Christmas and I didn't have a Christmas tree for my kids. And so I went to the lot and it was empty, and it had a little paper sign that just said, "Help yourself." And it was just like this little, it wasn't a real tree. Brought it home, and my oldest son's cheering. He's like, "Yay, Christmas tree." I'm walking up the front steps and I just broke down crying because I realized it's like, okay, like I was having a good time, right? Working in these two worlds, doing what I enjoy. That's like, this is too much. I mean, no Christmas tree, come Christmas Eve and just dragging this twig home. It was just too much. So I made a decision, but by then I think I was ready. I just thought, on the grand scheme of things with all those kids, it's sort of like, I thought of science as like my hobby, a hobby that I just really loved dearly and wished I could pursue. And there's a bit of the scientific approach if you want it, on the finance side.
Yep. I often look back at my science career and I occasionally think like, man, what did this cost me in terms of net worth to practice this hobby for the last?
Yeah, you don't want to do that calculation. But money's not everything, right?
Yep. Yep. So let's talk a little bit about how you got interested in cat bonds, because O'Connor, you might be trading commodities, options on commodities, things like that. And you did mention this idea of like back in the day, people would create liquidity, create new markets. In a way, I view you as somebody who played a big role in creating a new market, right?
Yes.
Type of risk. So maybe just talk about how that happened.
Oh gosh, I mean, it's a really long road. I mean, so I did, like 2 or 3 tours of duty on Wall Street, so to speak. And you learn a lot. I kept moving closer towards what you would call investing. You see, like when you're doing like high trading volume, tiny bid-ask spread, massively liquid markets, or you made them liquid and all. From that point of view, it's very micro. I mean, it's all just bid-ask, and there's a mentality of zero-sum game, right?
Yes.
It's not necessarily true, but it's overwhelming because that's the first order approximation. It's a zero-sum game. And I was, and the techniques around that are interesting, but I was fascinated by this because I could see that there's a whole part of finance that's not a zero-sum game. And it's like, and why is it not a zero-sum game? Because there's actually an excess return, and you didn't get it by just viciously ripping it out of somebody else's hands. It's inherent there.
Right.
So it's a fundamental proposition of finance where it's kind of like, look, it's a win-win if it's done right. You may not be happy with the terms, but in the end, things got done that wouldn't have otherwise, et cetera. So I just kept moving closer and closer to that. of course, too, like all things, in the end, it's employment. So you got to offer a skill that somebody wants and is willing to pay for. Back in those days, the investment side was getting creamed by the quants on Wall Street. So the investment side kind of wanted a Wall Street quant, almost purely for a defensive, asset, right? And so I kind of made it over to the investment side that way, and eventually ended up at the Harvard Endowment, right?
Oh, I didn't know you had worked there. That's amazing. Okay,
Yeah,
yes.
I was back in the Jack Meyer days, and it was like really golden age of that place.
Yeah.
I think most would agree. No disrespect to the current setup, but it's by the way too. It's not about that endowment in particular, right? It's about the evolution of finance, investing, the relationship between investors and Wall Street, et cetera, right? Constantly evolving. But like all things, there's and every moment's almost transitional, right? Nothing permanent. But there are going to be some moments that you might call golden, right? And they can't last because it's all transitional. And it was really, really interesting times. I mean, it's very intellectual, and yet practical, big macro views and zooming all the way down to the micro. I really learned a lot being there, enjoyed it very much. But there I was with my quant skills, on the so-called buy side, the investment side, and they really, really helped crystallize my thinking about not just markets, but about investments and like how the global economy works, because that's all that they talked about. And I got the phone call. That's it. Got a phone call from Lehman. I'd never worked for them before. And, they said, we're interested in starting a proprietary trading group around something called catastrophe bonds or something like that. We want to make catastrophe bonds. It's like, I don't know anything about catastrophe bonds. I said, that's the beautiful thing. Nobody does. And of course, I love stuff like that. I was like, oh, okay, that's great. And it was like a year. The conversation was practically like a year. And I finally agreed to come on. They did something very interesting and very honorable, I have to say, that I'm not sure if I ever told this story before publicly, but at the time that I was about to join on, there was, what was that at that time? Was that I think that was the collapse of long-term capital.
Yeah, right. That was 98 or something?
Yeah, 98, exactly.
Yeah.
And my first day at work was like October 1st or whatever like that. And then I knew I was leaving a good place. I mean, up to that point, Harbor Management Company, it's sort of like, it's like, it's a job for life, basically. And they called me up and they said, think of this, I hadn't yet joined on. There's no NDA. But they said, listen, there's a possibility that we're going to go under. The CEO's out there telling everybody it's impossible and so on and so forth. But, in the end, it's a game of confidence. If they lose confidence in us, it doesn't matter what our balance sheet is, et cetera, we're dead. Right? And they said, it's not clear whether we're going to survive. So, we thought you should know that before you come over. I was supposed to come over in a week or two.
Wow.
And we completely understand if you want to back out of your commitment and so on and so forth. Preserve yourself.
Those are good guys. Good guys.
They were. I got to tell you, every one of them that I interacted with and worked with were incredibly honorable. The person that actually headed that group was a guy named Mike Gelban. And Mike Gelban's actually officially I believe the last CEO of Lehman. People don't know that because he put his foot down when they were doing all those crazy trades that sunk them.
Yep.
He'd probably been there for like 35 years. He was the inside guy. And they basically, fired him or pushed him out for cowardice. Yeah.
Wow.
Yeah. Now back then, so Lehman Management was loaded, packed to the gills with equity options. That's kind of how they aligned interest. And, so people had their entire fortune tied up in that. You didn't just cash out and walk away. They're doing risk taking. But it's all locked up. You can't leave. You can't leave unless you're basically fired, without cause, of course. Cowardice is not a cause.
Yeah.
So I believe they forced him to liquidate all his shares of Lehman. So yeah, I think he looked. I believe that he basically was forced to liquidate at the very, very top. But
Yeah.
he was so visible and on record with putting his foot down like that as they were winding the whole thing up, I believe Treasury asked him to come back in and be the last CEO and help wind it down. So a person just of immense integrity. Yeah.
So interesting that in '98 they were warning you, being honorable guys, about what could happen, and then 10 years later they were gone.
Yeah. Yeah. I mean, there's a lot of the demise is very, very complex too, right? Yeah. Like how that all happened and so forth.
Yeah.
So I wasn't around, so I can't really speak to it. But yeah, what was interesting too is that the original approach I got from Lehman is actually to be a head mortgage-backed securities trader.
Great.
And so that was before the cat bonds, and eventually, and we talked about credit derivatives, and I told them that was the biggest blow up in the history of Wall Street where it happened.
Yep.
And not even jokingly, we both had a serious conversation about it, and they understood where I was coming from. They said, "Oh, you're talking like that." I said, and he goes, "Yeah, sure. But I mean, you'll be rich by then. What do you care? You'll be retired." Yeah. I was like, yeah, I know. This is 97. It's like, I know it could be like, it's going to take probably like 10 years or so for the mortgage market to blow up.
Yeah.
But, it's just not, it's just, I'm not interested. I want to kind of, I want to be in a market that I know going to be around longer than 10 years, and because I'm going to devote myself to it. And they understood it, but it was interesting. They, even they, in a very cold-eyed way, it's like, if you're talking like that, I'm not saying I agree with you, but I do understand. And yeah, it's probably about 10 years, and then it blows sky high.
Yep. So this may be a good time for us to introduce the listener to the idea of a cat bond. And let me give it a shot, and then you can fix what I say. So imagine that you're offering an insurance product. So let's say you put up $100 million against an event, and the event might be earthquake above a certain magnitude hits Los Angeles. And maybe you have some idea that this type of earthquake only happens once in 100 years. And so there's an expected loss, which is that 1% chance that it happens times the amount of principal you're putting up. There's that expected loss against what the counterparty would have to pay you to endure that risk. This kind of instrument is useful because it allows insurance companies to basically distribute risk so that they're not all holding it themselves on the book. It also allows the person who's putting up the bond to make some kind of return on their capital, which is maybe uncorrelated to ordinary instruments like the stock market, the bond market. So it is an example of a win-win kind of mechanism for risk distribution in which everybody's happy.
Yes.
Is that fair, John?
That's perfect. I just want to make it clear. So if the earthquake happens, then we, the investor, loses $100 million, right?
Right.
So we're not betting that we're not profiting from the death and destruction. It's perfect. Now, this is the key thing here. So you say, okay, you got a 1% chance of losing your $100 million in any given year, right? So the phone call that came from Lehman was because Warren Buffett had done this type of a trade with the California Earthquake Authority. It was just formed because the earthquake market had collapsed, actually. And I'm going to use round numbers here. So on that 100 million, Buffett was paid 10 million. So, and if you're, a numbers type, you just say, well, 1% times 100 million is 1 million. So the expected loss on average is 1 million a year. So, well, you got to get paid that at least, right? Otherwise, the expected value of this investment is negative. You got to have a positive expected value. And most people kind of walked around, they thought, well, I think if we believe the science, 1%, and I'm fine, I'm okay with it. But let's just say that that's just a agreed upon, uncontroversial number. Maybe that investment should pay you $1.5 million or 2 million. Let's make it 2 million, use a round number. So it's kind of like, it's like a retail markup. Like the cost of the goods is $1 million a year on that contract. Let's just charge 2 million and move on. But it was paying 10, you know? So that's, you know, but keep in mind, so the Wall Street mentality actually even thinks, well, we trade options all day long with a 1 delta, and we'll trade it maybe at like 1.5 or 2 times. Right? You know, and here it's paying much more. But I've been studying this issue, keep in mind, as I moved away from Wall Street and while I was at Harvard Management Company. And the numbers that they actually gave me, so it was more, I'm rounding here, they were very precise. They were coincidentally to 3 significant figs, practically. The same numbers that I was imputing or calculating was present in the investment markets. If you invested your money wisely, you know, nothing risk-free, you know, that you were getting this very healthy return. Mm-hmm. And it's more than what a market maker in the OTC options market would see. And it's persistent and consistent. So Lehman, I don't know, it was a phone call, so I couldn't see their faces, but it was kind of like, you know, it was one of those moments. It's like, okay, prepare yourself here. Okay. You know, this is, you know, what Buffett got paid or something like that. And I calmly said, you know, that is fascinating because it's coincidentally what I've been seeing, you know, over here in traditional markets. And it's like, what? No, that's not how. It's like, no, that's not how like traded markets work. You know, when you're a market maker, bid ask and so forth there. But at a very high level, investing kind of looks like that. So, and I told him, I go, you know, whenever you see these numerical coincidences, a lot of times it's just that, right? But I had a feeling that there was something deeper going on. I was really intrigued, and really, of course, you know, what in my mind, I was explicitly thinking, this is the investor choice problem that my father had been talking about. And I said, you know, I combed Wall Street for the answer. I really did, actually, because my father always said this. He said, you know, son, actually, the practitioners, they're kind of just way ahead of the theoreticians when it comes to stuff like this. Yeah. Right. Yep. If you look at like modern probability theories attributed to these letters that Pascal and Fermat exchanged with each other, right? Well, what were they talking about? Pascal was, you know, he was obviously crazy about gambling. A gambler, a very astute gambler, said, you know, your math doesn't work. He said, what are you talking about? He's like, according to your math, these two, you know, gambles have the same probability, the same relative expected value. He goes, but they don't. You know, by the way, no one's ever done this. I've combed the literature. If you were to actually just empirically determine that these two bets don't have the same probability of success, mm-hmm. you would have to do that gamble over 5,000 times each just to have any statistic. Yes. And these gambles are actually very laborious. You have to keep throwing a dice. One of them is you get to throw it over 24 times. Okay. Actually, the 24 times minimum. So you're throwing the dice over and over. It's an ungodly amount. And I suspect that actually this gambler had not collected that data and seen it that much, right? That he could intuitively understand mm-hmm. with data that a statistician would say is insufficient, yes. right? We see this all the time. There's a guy named Dr. Jarecki, you know about this guy? He passed away recently. Yeah, so that's a whole story unto itself. But I mean, he was a doctor and he was kind of like Hannibal Lecter. He was like this evil genius. And he could actually detect the anomalies in roulette wheels. He told people that that he had a computer, but he didn't. It was just in his head. And it's weird. The most subtle anomalies in the probabilities of a roulette wheel he could just detect by observing. Wow. And again, as I say, they're so subtle that statistically his observations are insufficient to see it. So my father actually always told me that. He says the gamblers, the people on the front line, they know things that the mathematicians don't. Mm-hmm. Mathematicians just figure it out. So, okay, it's like, oh, that makes sense. So on Wall Street, you're there. It's a giant casino. So you're just, you know, I was searching for the answer. Couldn't find it. But then I realized, there's a whole nother parallel market, you know. And by the way, the parallels are stunning. You know, today globally, there's roughly 680 trillion of derivatives, according to the Bank of International Settlements, right? You just Google search it. BIS derivatives outstanding. Boom. Should be right there at the top of the Google search. So it's like, it's roughly 600 to 700 trillion dollars in derivatives notional outstanding. If you do back of the envelope, the amount of insurance notional outstanding, it's 600 to 700 trillion dollars.
Mm-hmm.
So really, derivatives actually are, often actually just a form of financial insurance, right? Mm-hmm. But there's this original insurance market, right, that exists and most people think is boring. That's just as big.
Yeah.
It's been around forever and it has its own parallel culture that's kind of, in a sense, untainted mm-hmm. by, unmixed with what was going on Wall Street. So, and, and I know every good scientist does this. You're always thinking that way. It's like, what are all the tribalisms present, in my field, right? And you actually, it's like, well, this person's PhD advisor was this person. And like, all the lineages, all the schools they come, all their biases, what they hold precious and all their principles. And so you see all these tribal divisions in a field and you use that to inform yourself about where you might be able to, put a dent in the field.
If I could comment on that, there's this sort of actuarial culture. Those people know some math and statistics. And then you have this newer culture, which is a bunch of quant traders who know Black-Scholes and stuff like this. They often come from physics or math backgrounds. But there is obviously some convergence in what these people do, right? But very different cultures.
Very much so. You're right. There is some convergence. But I was, again, still obsessed about this problem. And I thought also, if I go over to the insurance market, maybe I'll find the answer there, right? Maybe they'll know. Right, they may not have formalized it mathematically, but that's easy to do once you see it. And so that was actually a big part also of my motivation to come on over, because I thought, okay, I'm seeing this kind of big macro behavior where you see this excess, return, which can be converted into a legitimate investment, but it's sort of like, but why is it that way, and why that numerically, right?
Yeah.
Why is it, 6.18 instead of 3.12,
Right.
And sometimes there is no answer. It's kind of like, it's just the way it is. That's the market price of risk. But there was something going on, I thought, and maybe I find it out on the insurance side. And, and I was right, actually. That's I found the answers, can I say, almost empirically on that side, and then wrote up the math.
So, for the audience, let me take a stab at this again. So if let's say notionally it was $100 million that I was putting up in one of these contracts, and if it's locked up for a year and I can't invest it during that year, I could have earned a risk-free rate on that money, right? So there's some base rate like LIBOR or some kind of risk-free rate that I could have earned on that money. I should earn an excess over that. And certainly the excess has to be greater than the expected loss, one would think. Yes. And so I think your empirical rule, which you told me 15 years ago, I still remember, is the coefficient is something like 4 to 6 times the expected loss should be the excess return over LIBOR that you would expect for that contract. Is that about
sure.
Right?
Exactly. Yeah. And it all depends on market conditions. I mean, recently that number got up to like 10.
Wow.
Or something like that. So it's kind of back to like the old Warren Buffett days. But 4 to 6 is a good rule of thumb. And keep in mind, with this 100 million, what happens is that the 100 million actually sits in a bankrupt remote trust, actually, and is invested essentially in T-bills.
Yeah.
Short, 1 month, basically treasuries. So you actually get that. So it's kind of like you just put into a CD, let's just say. So you get that. Plus that 4 to 6%, exactly.
Yep. And you either have to surrender it or you get it back, right? So,
that's right. Right.
Yeah. So I think what you just said a moment ago is that empirically this rule of thumb. So first of all, someone coming in with first principles like your dad might say, why is it 4 to 6? Like what determines that coefficient? Is that a universal thing? Like, does it not depend on the distribution of utility functions or risk tolerances of all the gamblers in the market? What determines that coefficient? And I think what you're saying is you both saw the empirical pattern, that there is a pattern, and then subsequently worked out a theoretical kind of justification for why the number is what it is.
Correct. Right. Exactly. So, I mean, the world now officially just says, well, like utility, that's, or in a sense, that's the risk aversion that the market shows or something like that. Well, everybody's got their own language for it. Wall Street people was, well, it's supply demand. There was enough demand for these bonds that you wouldn't pay as high and so on and so forth. And there's truth to that as well. But they would say that. So it's very kind of, Kahneman and Tversky, for those who are kind of into this. And, is there a movie or there's a show? I haven't seen it yet, but people say it's out.
Mm.
And it's obviously a Nobel Prize for Kahneman. Tversky had passed away by then, but it's sort of like, it's like, well, just interview a bunch of grad students and play games with them and say, like, here's a $10 bill. That's yours. Thanks for participating in this study, by the way. Now, would you like to gamble that $10? There's a 10% chance that this and this and this. And they're like, no, I don't know. Yeah. And then they just take it. And then in the end, they get these graphs and they say, hey, this is kind of what risk aversion looks like, and it's psychological, right? They're just, afraid of losing $100 like that in such a traumatic manner. So that's what they charge. And that's actually weirdly the prevailing academic description. At Wall Street would just say, well, the supply of cat bonds, the demand for this catastrophic coverage outstrips the supply of capital, the number of people like John Seo that are willing to take it on. So that's, of course, why it's there. And so, but none of that actually explains anything, right? And in particular, what it is that you'll actually notice that, well, 1 in 100 year California is like 4 to 6%.
Mm-hmm.
1 in 100 year Florida is more like 8 to 10%. 1 in 100 year Japan is like 3 to 3.5%, and it goes on and on. So it's like, why is that? And then they would just use these words. It's sort of like, well, the risk aversion is different there, or it's supply demand is different there, and all. But what I saw in a moment, where was I? I think I was on the train, doing my 2.5 hour commute from the Wall Street area back up to Connecticut. And suddenly it's like, oh my God, I think I can piece all those numbers together. I can actually show that if Florida is at 8.2%, then Japan should be at 3.12 or something like that, just piecing it all together. It's like, that's actually pretty damn close, to what's going on. And you can just see the whole structure of the market. And so that's what's missing in a way. These explanations about it's just risk aversion or supply demand, they don't really explain they don't explain the structure of the market, right? But there was a structure of the market that I could see empirically. And I had an insight into how mathematically that all knitted together.
Can I just ask, so these are would there be cases where let's suppose that just to make the assumption that the expected loss is something that can be known. And so you could have like a market like Florida and a market like Japan, where let's suppose we look at two contracts and they have exactly the same expected loss, but
yes,
the premium that's required to get someone to buy that contract is quite different in those two different markets. So so what's the other variable that could influence that premium?
Yeah, it's not, I'm not just saying because it's a proprietary thing, but it's in short, actually, the most succinct way of putting it is that the supply of the Japan earthquake risk in the private market, the government absorbs an ungodly amount of itself, is less than the supply of the California earthquake or the Florida one there.
Got it.
So
okay.
There are the Wall Street explanations. It's like, well, or put it this way here, they're all desirable investments, but the Japanese risk is a much more rare thing to get, right?
Got it. Okay.
Whereas Florida hurricane's plentiful. If you want some, you got it. So there's a supply and demand thing there, but again, supply and demand doesn't necessarily connect these two separate things. And so, but then how can you look at the different supplies and arrive at these numbers? typically what they have to do is just like, calibrate separate parameters for Japan and for California, et cetera. You can call those parameters whatever you want to, risk aversion, or just kind of like, supply demand type, parameters. But I could, in a sense, see unifying everything with a single parameter, right? As you know, that's the ultimate if you can do that, right?
So 15 years later, it's still proprietary, since I talked to you about it last.
Yeah.
And your competitors, do you think they know it, or they don't even now? Like, it's still a source of competitive advantage for Fermat?
Interesting. Fundamentally, I have to say I don't really know what my competitors are doing, but we can observe their behavior, and from our observations of their behavior, no, they don't do it. They don't have the secret formula or anything like that. And it goes back to my earlier story. There's whenever there's an area where there's enough excess wealth or returns being generated, I've noticed that behavior. People are like, why do I want to geek out? It's sort of like on Wall Street, they were waving in PhDs like ourselves. Well, it went in stages, but at one point it was kind of like, Jesus, at this rate, the margins are just going to go to, like they're going to be 100 times lower. So we got to quant up if we're going to survive in that. Kind of interesting, right? Makes sense. So it's kind of like, let's get some particle physicists in here, because the quantum of the profit margins is going to be like a subatomic particle. So we need, so we need people like that. But in general, as I say, if times are good and just money's rushing in, I think there's less of an inclination to do that. They don't quant it out. So in a certain sense, what we do here is more culturally driven, right? A business person might look at what we're doing and say, why are you doing that? And it says, well, it's intellectually stimulating. We like it. But actually more than that, O'Connor really taught people how to take in a quantitative advantage, right? And understanding, but also translate that into commercial stance, market approach, et cetera, how to actually carry through with that, not just be all smug. It's like, oh, we think, or we know we're the only one with the magic formula. And so that's it. We're just superior to everybody and we should just do better. O'Connor is like, no, there's actually ramifications to that knowledge and how you're supposed to act, position yourself, what your limits are, what your limits aren't actually, and on and on. And so really, but it does start with that, because if you don't have that view of a structure of a marketplace, it deeply affects your behavior, right? Because essentially what you do is that you become, can I say, I don't know, it's kind of a funny way of phrasing it. It's that you become more social, because there's a huge social aspect to the dynamics of a market, right? So if you don't have any kind of, can I say, math to inspire you to a structural view of the marketplace, then it's just all about relationships and whether or not you're positioned up here and your competitors are seen down here. And so now you get first shot at all the good deals and stuff like that. That is a way of going at a market, right? Yeah. And it doesn't necessarily, mean that you can't quant it out, but people who do that, it tends to be different, right? It's a power game. Where are you in the hierarchy and so forth there? And I don't think there's anything wrong with it. It's a very valid way to go about business, but that has nothing to do with math, right? So, so there's a fork in the road at the beginning. It's like, do you have this kind of scientific view? And typically if you do, it's because you were a scientist. That's all, right? Yeah. But the great thing about O'Connor is that they taught, can I say, scientists and engineers and mathematicians how to take that insight and, can I say, make it commercially viable. And I still think it's very, very telling that out of the hundreds of boutiques, and a lot of them were quant boutiques and so forth that UBS absorbed, only O'Connor is allowed to maintain its name on the business card as a distinct entity. Yeah, interesting. It's so strong. Its reputation is essentially unblemished.
Some years ago, I had a PhD student who was going to leave physics for finance, and I tried to teach him some financial math, and we did a little project before he left, and we looked at, I think, deep out of the money options and the implied, the valuations, and it looked like there was a pretty big premium for that kind of tail risk, selling that kind of tail risk. And I never checked to see if it obeys your rule of thumb. I should go back and look at that.
It probably does now, actually.
Yeah.
So in the old days, it didn't, because Black-Scholes doesn't really guide to that, right?
Right.
Because like the so-called fat tails and the adjustments that you make to the Black-Scholes model and the tail are effectively one giant fudge.
Exactly.
Fudge. It's sort of like, we just empirically see it's there, and so we gotta fudge it, and then you backfill all the reasoning. It's like, maybe it's stochastic volatility, whatever. It's like, and I know it sounds like I'm making fun of it. I'm really trying not to, but you have to admit that the structure of Black-Scholes really doesn't lead to the fat tails.
No.
So fine. So in the old days, it wasn't that way, and it started to change because, I'm aware of this. It was an actuary that got a hold of the options book I think it was at Merrill Lynch at the time, and he was just an actuary. So actuaries are used to seeing any anomalies like that and just saying, hey, that's just value.
Yeah.
But then created a giant short option position, which he was delta hedging, to be fair. And then the market gapped down and you just blew sky high. Of course, back in those days, Wall Street was always fascinated with people. If you fail small, then you're a loser, right? But if you lose like $300 million or something like that, it's like, wow. It was kind of like, I know the story because after the blow up, everybody on the street wanted to hire this guy. And so the firm that where I was at that time, the seat, I had to interview the person. I was like, it's going to have to be after hours and can't tell anybody. It's like, well, I'm always here after hours and I usually don't tell anybody anything because I have no social life thanks to you. It's like, okay, anyway, so this guy's going to come in and he's going to speak to you. We want to know what you think about his quant skills. And he basically just told me that story. So it's like, I don't know what the deal is. And like these out of the money options actuarially, have a very, very high premium to them that's not explainable in any other way.
Yep.
So I shorted them. I'd do it again. I don't care. I don't apologize. But of course, after enough of those blow-ups, the market, actually reprices it. Mm-hmm. So people, and if you listen to that history, it's actually, why is it priced there? And it's like, well, yeah, career risk. That's why. But it's not true. And actually, every time I glance over my shoulder at the pricing out there, it looks very much like the cap bond market. So, that convergence that I was kind of talking about has really taken hold.
Super interesting. Now, we've gone over an hour, and I said we were going to shoot for about an hour. Maybe I can close out or start to close out a little bit. Just ask you a little bit to reflect on, because I think Fermat was relatively new. I think actually when I knew you, or you were running it out of like a house behind your house or something, maybe in Boston or something, or Cambridge. And now it's looks like a big firm with 30 or 40 employees or whatever in Connecticut. Just talk a little bit about your journey. Like, what were the challenges? What are you most proud of in building your firm? What does the future look like? Anything you want to say about that?
That's interesting. Okay. Yeah. Oh boy. I mean, doing something like this, the challenges that first dollar in, getting somebody to back you, so, the finance is all about, well, now you got $1 billion. Okay. So now you can, that's the hardest. And then you can get to 5, you can get to 10, and then you can get to, but how do you get from 0 to, non-zero? That's the hardest part.
Yep.
And I still don't understand it. I still don't understand, in a sense, how firms like ours actually are able to survive. Now, there's a huge element of luck to everything in this, right? Not all just hard work and brains. It's just, you have to be lucky. The stars have to align. You're at the right place, and naturally you're prepared, right? So I'll tell the story. I was out there trying to raise money, and it's just like, it's impossible. I mean, people are literally like, we're scheduled for a 30-minute or 1 hour phone call, and they terminate the call after 3 minutes. Yeah. Everyone, it was a famous endowment, right? And it's like, oh, okay. So it used to be at another endowment. Great, we'll take the call. It's like, okay, before we like, I don't want to hear all the razzmatazz. It's like, what are we even talking about? I said, catastrophe bond. I said, okay, forgive me, John, but I thought the idea was to keep catastrophe out of the portfolio, not to deliberately bring it in. So this call is over and you have a good day. That was it. Now, back then I just had the cell phone, and Nelson was pressing his ear up on the other side to hear it. It's just like, plunk. Just so it was like that. So, and then you have in-person meetings too. And, it's just terrible. And so like I'm walking around Midtown Manhattan and, it's, my feet hurt, I've been rejected, 100 times over, and I get a phone call. So it was a hedge fund manager that had a giant wait list, billions of dollars, right, on a wait list. And he was trying to get that money to his traders. He had a bunch of traders and all kinds of different strategies. But those traders were all disciplined. They didn't want to run more money than they could. Yep. And he couldn't force them and kind of didn't want to. Yep. It's like, come on, man, just take the money. You can do it. And they're like, oh, no. So I found this out years later. So he was like, I basically have every strategy that exists. Like if there's a profitable strategy, I find the person, pay him triple what he's being, paid at wherever he is. And then he comes over and that's it. He works for me. So it's like, I got to find something new, something that doesn't exist, actually was the term apparently he used. So apparently he had his staff pull up a list of 1,000 candidates, whittled it down to 100, and he personally interviewed every one of those for an hour.
Wow.
They were kind of getting desperate because he was getting super irritable. The guy was very sharp as they come. So he'd be interviewing these people, and then he'd tear into them, and they'd be in tears, and they'd run out of the building and stuff like that. And so finally, one of the guys I was tasked with finding somebody to feed this manager got me to come in. I didn't have any PowerPoint slides. I just had a bunch of lab notebooks. I'd never been in an office like that. It's something I like out of a Hollywood movie. And yeah, my brother and I started out of my garage, the whole thing. So, and I said, okay, Mr. So-and-so forth will be with you. And the guy comes in a beautiful 3-piece suit with a silk tie, magnificent silver hair. And he goes, you have 1 hour, go. And he just sat down like that. So I spoke for like 50 minutes. He gave me no feedback, just talked for 50 minutes. And at the end of it, he said, I love it. I'm going to give you 100. Now, normally my old nerdy self would sit there and try to make small talk with him for the next 30 minutes out of excitement. But I'd learned that in business, when you get an answer like very unexpected, exactly. So I stood up and said, thank you very much, Mr. So-and-so. And I just walked out. And I was like, so how does this work? What are we going to do? I just shook it, walked out. So it's like, but that's lucky, right? It's just, I found out years later at a Christmas party, I think out of the 100 that he interviewed, he gave money to 2.
Wow.
Because it almost sounds like a Y Combinator type thing or something. It's like you have all these things, there's this giant funnel in the end, but that's luck too, right? Who knows? I mean, he got up on the right side of the bed that morning for me. Yep. So, and if that had not had happened, I don't know. I don't know if I would have raised the money. I'm pretty determined, but it requires stuff like that. When people ask me about their advice in science, because I get that question all the time, I don't recommend it. And I don't think I ever do. Now, as you know, a lot of people have already made up their mind to go, so you do the best you can to advise them. Mm-hmm. But they haven't made up their mind. I don't necessarily recommend it. It's just like everybody's just looking at the, people like myself that made it through.
Yes, survivorship
But there's
bias.
there's a massive element of luck to that.
Yeah. That's great. Well, maybe we should just end it there. Really appreciate your time and wish you guys continued success at Fermat. Are you bullish on the future of the cat bond market?
Oh yeah, absolutely. It sounds terrible because it's like, oh yes, there's going to be lots more, destruction and so on and so forth. Actually, I will say this simultaneous with that. It's really, a lot of these risks are very similar to what fire risk was, catastrophic fire risk was before. Ultimately, actually, it's a building code issue, right?
Mhm.
So, back in the 1600s, 1700s, 1800s, they suddenly discovered, it's like, holy cow, all these cities are flammable. It's like, yeah, no duh, thatched roofs, everything's made out of wood. You use candles and stuff like that to light everything. But it took them like a couple hundred years. It's like, well, that's crazy. That means that like I could be asleep in my building here in a major city and then die in my sleep from a fire that happens 20 blocks down, right? And if the wind is blowing just in the right direction. So, insurance got involved and eventually just developed all the building codes, basically all the fire codes,
Mhm.
which still persist to this day, right? To actually fix the problem. And so all of our, so I'm obviously an optimist, all these problems are very fixable from the vulnerability side. But in the meantime, you've got, $10 trillion in physical property that's exposed. And right now, cat bonds is the most efficient solution for actually dealing with that while that resiliency transition happens.
Now that you mentioned that, maybe let me ask you one final question. So,
Yeah.
are your contracts of sufficient duration that the market you're in actually tells you something about what the market thinks about climate change? Can you see that people are pricing in really significant changes in the next few years? Or
Yeah, they're pricing in significant. We don't need it to be long dated, So the intention of the market and what it's pricing and not pricing is always very clear. You don't need a contract, not in a niche market like ourselves.
Mhm.
And they price in a tremendous amount of climate change. I mean, they're basically taking the worst fears of 100 years of climate change, worst fears, upper bound, the whole thing there, and then pricing it in as the here and now.
Wow.
So they are, but it doesn't. Maybe it's a whole nother talk. But I'll just tell you, in some, I don't subscribe to those views. The empirical science and even the developing science does not support that. But they're not gonna listen to me, and it doesn't matter. So it's just like it's bigger.
Does that mean there's some excess returns to be made there? So it sounds like people are pricing in really big effects from climate that maybe won't materialize in the short term. Is that, did I
Yes,
understand?
correct. Oh, for sure.
Yeah. Great.
Right.
Okay. Well, hey, John, I appreciate your time. I know you're super busy. It was great catching up with you. I hope I will catch up with you before another 15 years go by.
Yeah, please, in person too. It's terrific to see you. You're looking terrific.
Yeah.
And I'm going to look up that T-shirt. What do you have on there? Super focused.
Oh, this is an AI company I started, which builds AIs that use large language models, but they're narrowly focused so they don't hallucinate.
Mm-hmm. Yeah.
You deploy them typically in call center or customer service environments. They can fully replace people in those environments.
Very nice. Very nice.
Yep. Fun stuff.